Hey folks, good afternoon. It's Dave Burrows. I am CIO and CEO here at Barometer Capital Management. I want to welcome everybody to today's call. Here we are on October the 1st. Often October is a little bit scary, but to be perfectly honest with you, jumping ahead, the data is pretty supportive. Market's in a pretty good spot. Not everything, but certainly lots of things to do. Portfolios are looking pretty good. And what I want to do as usual is take a sort of a top-down view of the world and take a look at kind of how things are going. I think that we enter the month of October on a footing where the market's in a place to absorb bad news. So market's been marching its way higher since 2013 with interruptions. We've had a series of corrections along the way. And of course, the month of September, once again, a positive monthly bar. We're down about 1% to start the month of September. But, we did in the S&P work our way higher, exceed the high from July, exceed the high from August, and close the month at a new high. So the statistics are pretty good when the market has been up 8 out of 9 months on the year. We'll look at some of that data later on. It doesn't mean that October can't correct a little bit, but in general, we think that things look pretty good. Importantly, we talked over the last little while about the fact that the equally weighted S&P 500, marched on to a new high well before the market cap weighted S&P. And that's important because in the equally weighted index, of course, we're weighting every company exactly the same. We're looking at a broad cross section of companies, 500 companies. And as I've mentioned, just over 70% of stocks in the S&P are now ahead of the index on the year. And early in the year, we said that it was likely that that could be the case. It was actually more usual for the equally weighted index to do better than the market cap weighted. And we are seeing that at this point in the last little while. So this is as of about 3 o'clock this afternoon, down slightly on the day. NASDAQ's a little bit weaker. NASDAQ has been the problem child recently after being a star for a long time. The QQQ, or the NASDAQ 100, made a high in July, pulled back about 16%, rallied, could not get back up into this rising channel, pulled back again above a rising moving average, moved higher again, as undercut this channel, and down today, a weaker day. So this is the part of the market that probably is the most broadly owned. Certainly the names are the best known names in the market. And there are some really good ones in there. But in general, the large cap technology a lot less dominant. What I think is really bullish when I look at a long-term chart is that the value line geometric index, which is made up of an equally weighted basket of all of the stocks in the US, only recently came out of a range that it's traded in going all the way back to 1998. Now, in 2020, it had a big boost, and then it's chopped its way sideways as we've gone through a global tightening cycle. But you can see in the month of September, popped its head above this range it's been in over the last 2.5 years. Now, to me, that's really bullish. We want to know when more and more stocks are performing well. And this is one of the best measures that we look at, not a well-known index, but I think it's very instructive as to what's happening internally in the market. When we look outside the US, we've talked for some time that global stocks have been behaving much, much better. Japan, after having this, really monster move through 2023-24, has been consolidating over the last few months in a nice little tight range. Generally, when you get in a tightening range like this, when you eventually get out, which we're darn close to, you've got another measurement higher. And I think that that's most likely. It was interesting that overnight, Warren Buffett issued another tranche of Japanese yen denominated bonds, likely with the intention to add more holdings in the Japanese stock market. That's a real turnabout. Of course, he's been a buyer of Japanese stocks over the last 1.5 years. India continues to march its way higher in this very steep ascent. It wouldn't surprise me to see it correct a little bit, but frankly, we don't ever try and pick highs. Since it was $33, it's the EPI ETF. marching its way higher. Here we are at $50, and so we think that we're in the still relatively early stages of a longer term bull market here. Taiwan certainly acting better. We've talked about Argentina, some of the Latin American stocks. Peru is behaving particularly well, partly because they do have pretty good exposure to gold and silver. They've got pretty good exposure to copper. And now we see what's happening in China. So China has been the problem child in global markets. Their economy has had lots of difficulty, a lot like what the US went through in 2008-9. But in the last week, we have seen the bazooka come out. Not only have they launched very significant and sizable monetary policy stimulus, they have moved aggressively in the property markets to support property markets, importantly, relaxing curbs on non-local buyers and cutting mortgage rates. What I consider to be a bazooka is the PBOC, the People's Bank of China, suggesting they would lend money to funds and institutional investors to buy equities. They talked about $500 billion. And if that wasn't enough, suggested there'd be another 500 billion behind it. That's them basically saying, enough, we want to see our market start to firm. So this whole range of stimulus, fiscal, monetary, and market support has a big impact. First of all, institutional investors were very light China. So what's happened? CSI 300 was up 26% in a month. So most of this over the course of a week. Now, we've talked about global stocks for some time. That's why we started our global equity portfolio, which is the MSCI All World Index ex-US. It does have some China exposure built into it. It had a wonderful month. It's up about 10-11% in the last month. But Chinese stocks have been the lone holdout. Now, this range that Chinese stocks have been in over an extended period of time is effectively a bear market. We saw long-term bear markets in almost all global markets, frankly, including Canada, and we'll touch on that in a second. But this has been the lone holdout. And so when we see it break out above this declining range that it had been in, it's not insignificant. Institutional investors have become very frustrated and very negative on Chinese stocks, getting down to almost record lows in exposure. And we've seen have an impact on markets around the world because, of course, depending on where you're looking at, there are many markets that do have significant basic materials exposure. And basically all the commodities had a great bounce over the last week. And many of them have global industrial company exposure. So TSX has continued to march along. In fact, TSX is outperforming the S&P over the last number of months, as are global stocks. And when we look at a very long-term picture, the MSCI All World Index versus the equally weighted S&P, the All World Index has now been outperforming since the middle of 2022. And we're just crossing this, downward boundary. So we think that this is the very beginning. We put a 5% weight in most portfolios that we manage. We'll likely take that to a 10% weight over the next number of weeks because we think global stocks in general under-owned. They're very inexpensive relative to US stocks, and the sectors that make up the global markets, performing particularly well. So the Chinese stimulus has a big impact. So the rate cutting cycle that started in the US has a big impact, and it has an impact on stocks. Of course, we can see it in global stock markets. European stocks strong, Asian stocks strong, Latin American stocks strong, and it has an impact on commodities. Now, when we look at rates, we've talked a lot about the fact that we saw a reversal in long-term rates. Rates have been sort of benign over the last little while. There's no real momentum higher. There's no major momentum lower. If I look at the 20 and 30-year US Treasury bond, they've basically been marking their way sideways over the last year, up from the low point in October of last year, about 9%. That's one of the weakest returns for assets that we've seen. And other income producing assets have behaved a lot better. Certainly dividend paying, dividend growing stocks are outperforming bonds dramatically since rates started to rise back here in 2020. And certainly putting in a series of higher lows that continues to be favorable. And that's really where we've leaned into income oriented ideas, looking for a rising stream of income in a world where realistically, even though inflation is a little more muted, we are living in a world of rising cost of living. And when we compare stocks versus bonds, stocks are basically at a new absolute high versus bonds from a return perspective. So stocks continue to be our preferred asset class. Now, currencies are an interesting thing. We've talked a little bit about the fact that the US dollar has been weakening. And every time the market corrected and the US dollar rallied, when the US dollar stopped rallying was when stocks started to perform well. Well, the US dollar has been weakening. We've talked about, the big rally it had versus the Japanese yen. We talked last week about the fact that after a decade of lower lows and lower highs in the Australian dollar versus US dollar, it actually started to show some signs in July and again in August of working its way higher. So this trend is reversed. We talked about the Canadian dollar firming. We've seen now the British pound start to firm versus the US dollar. So this is an important theme around the world. Now, interestingly, if I could put the Canadian dollar futures against that Chinese stock market chart, it actually would look a lot alike. Canadian dollar underperformed while the Chinese market has been really weak. And we saw this turn higher around the same time as the Australian dollar turned higher. So global currencies improving versus US dollar tend to mean there is risk acceptance. It also tends to be favorable for commodities. Now, this is the last month, September. In the month of August, we broke above this little downtrend in a basket of commodities. We've been working our way higher now since 2020. We went through a global tightening cycle. We've seen a series of higher lows. My guess is we've begun the next leg of this commodities bull market. This is that same chart looking at a point and figure chart. Point and figure charts are neat because you can very easily quantify rising lows. And that's exactly what we're seeing, higher highs and higher lows. And over the last month, again, taking out the previous high from August. So looking quite attractive. This is against a backdrop where investors coming into August were exceedingly short commodities. They were making a bet that the tight central bank policy was likely to unravel the economy and send us into recession. It doesn't appear to be the case in any way. And certainly some improvement in the situation in China has been good for copper. We came down and tested that long-term uptrend line, and copper's had 4 weeks higher now. We've moved beyond, I think, this fear of recession, certainly more bullish. Now, while prices are moving higher, it doesn't mean that there is a supply response. When we look at Chile produces about a third of the copper in the world. If we look at a long-term chart, this is the period of the bear market in commodities. Chilean copper is currently at 2012 levels, even though prices are back at highs. It tells you that supply demand is tight, price going up, but there's not much of a supply response. And the reality is there's only a few new resources coming online, and it means that copper prices are likely to stay tight. Gold prices over the last month have continued to work their way higher. There's a very long-term chart back to 2012. And while it looks impressive, and on the year, it's the best performing asset in investable assets, it's only really the beginning. When we look at silver, just to put it in context, in the last bull market in silver, each rally got to significantly above the rising 200 week moving average, 79% above the moving average, 134% above the moving average, 149% above the moving average. We're currently 35% above the moving average. So to say that there is room for prices to move higher if we are in a new bull market, which it certainly appears that we are, would be an understatement. So I continue to put this up because it's an unpopular chart. Gold relative to the NASDAQ 100, giant outperformance from 2000 to 2011. And then, of course, NASDAQ really got going and performed really well. Gold performed poorly. We started to see initial signs back in 2020 that we were seeing a turn. And we certainly have seen a turn here over the course of this year. So my guess is gold continues to outperform for a period of time. I'm not a gold bug, I'm a realist, and our job is to recognize change. So we don't have to be everywhere. Our job is to try and identify leadership assets that are being revalued, look for change, new leadership to emerge and old leadership to recede. And of course, be willing to sit on our hands and do nothing in the event that there is no leadership. So we're trying to provide a tactical approach to things. We use our top-down model to try to identify parts of the market that are constructive, where we see money getting put to work, where risk reward is good. We don't have to be everywhere, but we've got to pick our spots. And then the fundamental team, Brian, James, and Amit, are trying to sort through all of the specific security universe that we look at, looking for securities to use to express our view. We're always looking for securities that are good getting better, where there's fundamental characteristics that support good value, but where we can see something's changing for the better, and where investors might be willing to pay a higher multiple over time. We want to see strong fundamental characteristics, and we want to see price characteristics, technical situations that would support that view. We like to see that the shares are doing well to begin with. And by doing that, we try to address each of the factors that drive return over time. So the top-down work is always driven by improving breadth. We're trying to find neighborhoods where over time, more and more stocks are performing well. In global markets, over the last number of months, one by one, global markets are joining the rally. That tells us global stocks are a universe we should be focused in. And on the other hand, when we see a sector start to underperform, where breadth is narrowing, where fewer and fewer stocks are performing well, doesn't mean we want to go out and shoot our positions, but it means we stop putting anything new on, which is why over the last number of months, we have had less and less of a weight in technology, because there's some great stocks there. We got some great positions, but there's not a lot of new breadth taking place in that neighborhood. So when we see breadth start to deteriorate, we tighten up our stops. We may raise a little cash, and we stop putting on new positions. So let's go back to our indicators. Whether we're looking at Canada, whether we're looking at the US, whether we're looking at the total universe of global stocks, over the last few weeks, the percentage of stocks performing well, or the percent of stocks in uptrends, is expanding. Now, I get it. End of August, September, October has been a scary time in a lot of cases. People don't like uncertainty. They don't like the fact that there isn't a clear leader in the electoral process in the US. They don't like the fact that we see, conflict going on in Eastern Europe, in Ukraine, and conflict going on in the Middle East. There's a lot of uncertainty. But the technical picture in the market tells us that there's enough positive things out there that it is outweighing the obvious negatives. The percent of stocks trading above their 50-day moving average continues to rise. Over 70% of stocks in the US stock market are trading above their 50-day moving average, which is a great measure of shorter term trend. The percent of stocks trading above their 150-day moving average is pushing up towards 70%. In fact, when we look at the percent of stocks trading above their 200-day moving averages, we are at the high for the year. So this is really favorable. It means 80% of stocks are in long-term uptrends. That's a healthy market. So we always watch what happens in the market day by day and week by week. I look for change in these indicators every week. But I can tell you that the internals of the market have only been strengthening. When we look around the world, you can see, if I put all of the major markets on a distribution curve, where at the right side, if a country were down here, it would mean 80% of stocks are in uptrends. Or down here would be between 0 and 14% of stocks in uptrends. The average country has 46% of stocks in uptrends. The ones in green have been showing expanding breadth. All of Europe, all of Asia Pacific, all of the US, Australia, London, Japan, now China, Hong Kong. This has been steadily turning more and more green and moving to the right, meaning more and more stocks are performing well. Having said that, this gets overdone when they all get stacked up down here on the right side, when almost everything's going up. So the reason we like to find geographic regions that are going from hated to liked is generally if we can get to the strong stocks early, as other people come in, they lift the boats. And so we are positioned in global stocks, we're positioned in US stocks, we're positioned in Canadian stocks, and we're trying to target the leadership sectors in the market because not everything does well at the same time. Now, over time, more and more sectors are performing well. Financials, which has been by far the biggest weight in the portfolios through the course of the year, almost 25% of firm assets, went out of the month last month at new highs. So whether we're looking at insurance, which as of today is making another new high, and insurance is made up of property and casualty, Fairfax Financials, I've said lots of times, the largest position in the firm, went out at another new high today. Or whether we're talking about life insurance, Manulife Financial, one of our big positions, or Progressive in the US, this group almost consistently is doing well. The capital markets banks. Now, this is a great tell for equity markets. You would expect that if the capital markets banks are doing well, the ones that trade lots of equities and bonds, the ones that do new issues, it's likely that investors believe markets are on a good footing. And you can see they've been marching steadily higher. So financials continue to be really attractive. The second group that we focused on through the year has been industrials. And industrials are a broad-based sector. They came out of the sell-off in 2020 earlier than the rest of the market, about 6 months earlier. Market bottomed in October. They started rallying in April. They've been working their way higher here over the last number of weeks. Now, defense stocks, arguably, are a beneficiary of some of the difficult things that are going on in the world. The PPA, which is the Aerospace and Defense ETF, had a big day today. We continue to hold General Dynamics and Howmet Aerospace. I don't want to put them up every week, but they continue to march higher. We also talked about BWX Technologies last week, and we've talked about it through the course of the year as being a leader in small modular nuclear reactors. And lots of great news on the nuclear power front this week. One of the US agencies said they've had a record $59 billion worth of applications to reopen nuclear power facilities in the US. And we've all read the news about Microsoft organizing to reopen 3 Mile Island from Constellation Energy. So nuclear power continues to be a theme that's important. The materials sector hit a new all-time high at the end of last month, certainly helped by the China news. Gold stocks, about the best performing sector in the market. Relative strength has been rising through the course of the year. We continue to add in that area. The copper stocks, after coming down and testing support, have all turned higher off of that. So Freeport, Teck Resources, 4N Mining, a whole series of stocks in that group. And staying on the resource theme, even though the sector has been lagging, we saw the Canadian energy producers hit support and rally off it. A lot of the big companies up a bunch today. I think that Imperial Oil was up about 4%. Suncor was up about 4%. And we're certainly continuing to see the pipelines perform well. Great source of yield. This is Pembina Pipeline, moving condensates in the area of the oil sands, and TransCanada Pipe TC Energy up today at 1.2%. These are paying great dividends, and certainly I think a lot more attractive than fixed income. Staying on the income front, utilities continue to work their way higher. This is the XLU ETF, NextEra and Southern Company, the two biggest holdings. They happen to be our two big holdings. NextEra, the leader in renewable power, made a new all-time high today, trading better than 92% of stocks in the S&P. And Southern Company, with their new facility in Georgia, their new nuclear plant that opened up about a year ago, made a new all-time high today as well. So understandable in the fall, income producing assets tend to perform pretty well. Utilities performing well. REITs have been performing well. They pulled back a little bit over the last couple of weeks. Our big holding, Simon Properties Group, basically went out in a new high today, and the residential REITs are outperforming the sector. So on the income side, we're continuing to focus on dividend growth. We're continuing to focus on companies that pay a sustainable dividend with some steady growth. And equities, income equities are performing much better than fixed income markets. In the consumer, we've been a little cautious. We continue to have some exposure to home building and specifically home construction materials. They are performing well. And then we've stayed with the lower price retailers, Dollarama, continue to act well, Loblaws, Costco in the US. But not a lot of consumer discretionary exposure. We'll see what happens next. Now, tech continues to be a little bit problematic. You can see just this simple blue line by the fact that it's moving lower means that the sector has been underperforming the rest of the market now for several months. We've been unable to make a new high since the early part of the summer. And today, starting off the month a little weaker. Today is the first day of the first quarter for mutual funds for 2025. So if they've come through year end, they're now in a position where if they make a sale today, it doesn't impact taxes going forward. So we may see a little selling. We're a little bit cautious in the group. Semiconductors are the same thing. They've been unable to make new highs. So weaker relative strength, weaker breadth. We've been more cautious in these groups. So when we put it all together and put the sectors on one of these distribution curves I just spoke about, you can see the average sector in the US market has almost 50% of stocks in uptrends. Now, the good news about that is when you get through 50, if you threw a dart, you've got better than a 1 in 2 chance of making money. But certainly, the first stock to double in a strong sector is generally the first one to double again. So we want to stay with the strongest stocks we can find. At the right side of the spectrum are the sectors with the highest percentage of stocks performing well. Banks and insurance companies. Well, these are our biggest weights. Utilities, which we added in the spring, and real estate. Also financials, Wall Street, which we talked about today, and home builders. From the industrials group, the machinery producers performing really well. The bulge is kind of here in the middle. Those that are in green have the strongest relative strength versus the market, and the weakest are on the left-hand side. So we're moving to the right. That's healthy. When we look at the sector weights across the firm, not a lot changing. Financials are our biggest weight. Technology a significant underweight versus index. Industrials an overweight. Energy an overweight. Materials an overweight. And then when we get to the more defensive sectors, staples a little bit underweight. Healthcare underweight. And communications underweight. Utilities and real estate now about equal weight with the index. And the consumer a relatively small weight. We got 2% cash. Portfolios continue to chug along. Since the beginning of the year, the equal weight S&P is up 14.9%, the TSX up 17%. There's a turnabout. The aggregate bond index is up about 4%. Our equity portfolio is up 17%. Income portfolio is up 19%. Certainly happy with that versus a bond market up 4%. And our global portfolio up 19.15%. When we go back to the beginning of the broadening, you can see portfolios have had a great go. Market started to broaden in the middle of March 2023, almost 16 months ago. Equity portfolio is up 37% since then. Income up 33%, and the global portfolio up 36%. We are in this new liquidity cycle. Central banks are cutting. To look at it another way, global money supply is lifting. Now, when money supply is lifting, there is risk over time that the cost of living goes up. There's more money in the system, prices can go higher. As investors in risk assets, we want to look at monetary conditions and financial conditions. And as the S&P has been going higher, we can see we have supportive things, a weaker dollar, falling bond yields, falling oil prices, and rising gold prices. Those are easing financial conditions. When we look at earnings, estimates for 2025 are not going lower. So earnings based on analyst views on the street continue to look much stronger next year versus this year. When we look at the index of economic surprise, which is a summation of all the economic data coming out in the US and whether it is beating expectation or weaker than expectation, for the last 3 months, the economic surprises have been to the upside. So lots of pessimism, but numbers not being as bad as what people might expect. When we look at how bond investors are feeling, they are demanding less premium to buy high-grade bonds or high-yield bonds. And when we look at volatility, volatility is trading in a range that it has tended to trade in during the best of the equity bull markets. So I understand that there's a lot of bad news. I understand it's a scary time of the year. We're coming up to Halloween, which often has not been a fun time to be in the stock market. But the fourth quarter is the strongest quarter of the year once you get beyond the first few weeks. I think it's really positive that in emerging markets, the consumer discretionary sector is taken off. That's a bet that the consumer can get better. In Canada, if we break it out over time, since 1920, the fourth quarter is the strongest quarter, up 73% of the time. The fact that we've come into the fourth quarter on a solid technical footing with improving breadth conditions in the market is better than is typical. And I mentioned this at the beginning of the webcast. From my friend Ryan Dietrich, when the S&P returns were higher 8 of the first 9 months of the year since 1950, October can be a little mixed, but on average it's up. But the fourth quarter on average was up 6.6%. and was up 100% of the cases since 1950. So we're cautiously optimistic. We're always looking around the corner to see what could jump out and bite us. But I still think that we are only a few months into what is likely a 24 to 36 month period where we have relatively low volatility and opportunity to have returns. If things get difficult, we have a tendency to play defense. And we certainly wouldn't be afraid to get more defensive if our conditions got worse. But for now, we've got to take the signs from the market. We continue to question our positions every day. If things need to change, we'll change them. But I think we're in a pretty good spot. So I think the big points for this week were certainly it is supportive that China is getting up off the carpet. We think this month it's certainly positive that we started a cutting cycle in the US. I think it's really a positive that we've got strong and improving breadth conditions around the world, not just in the US. Gives us lots of opportunity to diversify. And for income investors, dividend growth investing appears to be the game that's in town. And I think it's relatively early on in that process. So let me just take a look and see if we've got any questions. Oh, we got a bunch of questions today. So let me see what we've got here. Oh, I'm worried that I wasn't sharing my screen. Okay, can't see your screen. No charts showing. I see all these now. Well, I've done it. I apologize, folks. For those that are still there, I apologize. That's a first in 3 years. We'll see if we can't do better next time. Doesn't look like I got any questions here, so I apologize. We'll see you again next week.